Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our periodic commentary on markets and economic events. Let's get started. This week's hot topic is the red hot increases in inflation in the U.S. economy. It was released this week that over the past 12 months, prices have been going up at about a rate of 6.2%. That is the fastest rate of price increases since the early 1990s. And unfortunately for the Fed and the Biden administration and policymakers, the price increases are starting to become more broad-based. About 40% of reported prices were up 4% or more. So it's no longer, you can dismiss it, oh, it's just used cars and hotels and so forth. These broad-based price increases have to be alarming to the Fed. So we're going to talk about it. We're going to talk about why is inflation such a problem. We're going to provide a little bit of good news about some prices and where they may be headed over the next several months. And we're going to have to acknowledge that there's some bad news about where other prices may be headed. And then last but not this week, we will defer to next week talking about what does this inflation data mean for investors. So let's start first. Why is inflation such a problem? And really importantly, in the current environment in America, whose fault is it? Because I've heard a huge amount of people say, oh, this is all Biden's fault, and he messed this up, and he did that wrong, and that's why we've got some inflation. And of course, my Democratic friends are on the other side of that debate, saying, oh, are you kidding me? This is all left over from Trump and all the mistakes that he made, and it's all his fault, so that's why we've got this problem. And the truth is the actual people to blame for this is economists. Well, not economists really, but economics. Basic Econ 101. This is an entirely predictable outcome from the policies that were put in place first by the Trump administration starting back in March of 2020, but continued by the Biden administration as the very first thing they did when they came into office back in March of 2021. And what are those policies? What is it happening? What is the basic economics that's gone wrong here? Well, it is basically the fundamental equation of inflation is too much money chasing too few goods. And it was inevitable and predictable that the U.S. would eventually find itself in this predicament of too much money chasing too few goods. How do we know? Well, because little old Caravel Concepts predicted that we would find ourselves in this exact situation way back in March of 2020 with our publication, Modern Monetary Theory to the Rescue. Because what that publication talked about and what has happened is that starting in September of 2019, the Federal Reserve has printed trillions and trillions and trillions of dollars. And, there were a lot of people that said, well, but so what? So what? The Fed printed trillions of dollars in 2008, 2009, 2010, all the way into 2014, and we never had any inflation. Why should we have inflation this time? Let's go back to the formula. Inflation is too much money, trillions printed, chasing too few goods. Well, back in 2008, 2009, we'd had a housing crisis. We were having massive defaults and foreclosures, and people were being thrown out of their homes. And not only did that mean that there was a huge surplus of homes on the market, but it's a funny thing. When people are being thrown out of their homes, they don't buy cars, they don't go out to eat, they don't buy much furniture or any other thing. And that meant that the U.S. economy had a surplus of stuff everywhere in the economy. And since they weren't going out to eat either, there was a surplus of services everywhere in the economy. So yes, we printed a lot of money, but we had a surplus of stuff that meant that we did not get inflation. Now fast forward to 2020, an incredibly different financial and economic crisis because this was a global pandemic. And then we literally shut down our economy throughout the month of April and into May. And all around the world, factories were shutting down. Things were just grinding to a complete halt. What that meant is that there was a lot of stuff, a lot of services, a lot of capacity to deliver the things that we want that just fell away, that went idle for a long period of time. And as much as we may want to believe that the global economy is like a car, you can turn it this way, you can turn it that way, you can spin around on a dime, it's not. When you shut it down, things break, things go off the rails. It takes a long time to get that global productive capacity back up and running. And that's all the headlines you've been hearing about, the supply chain issues and so forth. So unlike 2008, when there was tons of stuff and they were printing money, 2020, there have been shortages. 2021, there have been even bigger shortages. And yet they were printing money. So now the conditions for inflation are in place. Too much money chasing too few goods. And lo and behold, Econ 101, those rules apply. So what's going to happen from here? Is there going to be any relief to this horrible increase in prices that we feel at the gas pump, at the grocery store, in our utility bills? And the answer is, in some cases, yes, because some prices are likely to come back down. Let's start with the price that people care about the most, it seems, because it just gets flashed in your face every time you fill up your car: gas prices. It's a lot of fun to kind of see all the comments that people say, gas prices, this is all this president's fault or that's president's fault. And the reality is that presidents don't have a whole lot to do with global energy prices. Why are gas prices so high? Well, there are 3 major producers of oil in the world. The United States, believe it or not, we are often the number 1 producer, depending upon which month and year and so forth you look at. Saudi Arabia, Russia. All right, those are the 3 biggies. But there's a huge difference between the United States and Saudi Arabia and Russia. The United States relies on fracking technology to produce our oil. Saudi Arabia and Russia use that old-fashioned stuff that's much, much cheaper. It costs the US about $35, $40 a barrel, give or take, to pull a barrel of oil out of the ground. It costs the Saudis and the Russians maybe $8 or $10. Now, why is that important? Because when we shut down the global economy in 2020, when we said, don't drive to work, don't fly in an airplane, don't consume much oil, not too surprisingly, the price of oil collapsed and it fell below the price at which American producers could make money, while the Saudis and the Russians still could produce at a profit. So that has big implications for us, because the other implication of fracking is, unlike a traditional oil well where you put your drill in the ground, if you strike oil, it's good for 20 or 30 years. All right, a fracked well, you have a much higher percentage of getting oil if you put a drill bit in the ground. You're almost certain to hit oil, but the well only lasts 2 or 3 years, not 20 or 30. That means that you're continually having to invest in new wells to offset the wells that are hitting their 2nd or 3rd birthday and their production is collapsing. Well, you can imagine last year when all our oil producers were losing their shirt on the investments they made in fracked wells in 2018 and 2019, they're not super enthusiastic about making new wells. And lo and behold, last year, rig counts, the number of oil rigs that are punching a hole in the ground here in the United States, collapsed to close to all-time lows, which means we didn't make the investments in new wells to give us productive capacity this year. Now, since in the last 6 to 7 months, we've had a huge surge in drills that are punching holes in the ground. We're up about 75-80% relative to where we were back in October and November. But it takes time for that production to come online. And more importantly than just the mechanical and physical barriers of you can't turn on a dime. It takes time to get these oil rigs up and running. There's also a little bit of twice bitten, thrice shy for oil investors, because Everybody that invested in oil in 2018, and 2019 lost their shirt last year. And that memory is painful to them. And this isn't the first time it happened. They invested when oil hit $100 a barrel back in 2014. You may not remember that. Remember oil? You remember gas at like $5 a gallon and stuff in 2014? All right. Back in 2014, they invested a lot in fracked wells, and Saudi Arabia and Russia said, wait a minute. America is exporting oil again. They're the #1 producer of oil. We can't have that. And they cut prices below where our fracked producers could compete. So fracked well producers, investors lost money in 2015, lots of money. They lost money in 2020. And they're probably looking at right now saying, gosh, $80 a barrel, we could make so much money, but they're a little nervous about the amount of money they lost in the past. And that's probably slowing the ramp up in our investment in new oil wells. Will it slow it permanently? Absolutely not. As I said, we're already up 70, 80%. And with oil having doubled this year, we're actually seeing that investors can probably lock in a price of oil that will allow them for the next 2 or 3 years to profitably pump that well for as long as they need to get an attractive return. Oil prices are now that high, so we're going to get some production going. And that production should bring gas prices back down as oil prices go down. It's just a matter of letting the process play out. It'll take a few more months and it won't be fun. With respect to cars, every car maker is desperate to sell at these unbelievably great prices that they're seeing right now. And they know that the demand is there. They are figuring out the supply chains. It will happen, and you will see used car prices go back to something approaching rationality as new cars start coming off the assembly line. That's the good news. All right. Now there's some news that you'll probably think is good if you own a home and not so good if you don't. Because if you don't own a home, you're probably hoping, can we have a 2008 so home prices come back down to something a little more close to what I'd like to pay? If you own a home, you're like, wow, I feel awesome. I don't even want to think about another 2008 30% decline in prices. Well, for that person, I've got good news for you. Home prices are probably not going to be coming down. So you ask yourself, why? And the answer is that why did prices collapse in 2008, 2009? The U.S. needs about 1.5 million new homes to be made every year. But the 5-6 years leading up to 2008, we made about 2 million homes a year. We need 1.5, we made 2. How do you get rid of all those excess homes you're making? Sell them to people who can't afford them using subprime mortgages, interest only, and all kinds of gimmicky stuff. All right, when those people prove not to be able to make those payments, then they defaulted, huge supply came on the market, we'd made too many homes for years and years and years, excess supply collapsed home prices. All right, contrast that with where we are right now. As you can see in the chart of housing starts for the last 20-25 years, since 2008, we haven't been making the 1.5 million in homes that we need. We said all kinds of silly things like millennials like living in their parents' basement, or they're never gonna leave that apartment in the city so they can walk to bars and restaurants and their coffee shops. Well, guess what? Millennials, as they start having kids, want to move to the suburbs for the same reason we did. A yard and schools for the kids. And yet we spent the last 10 years not making the 1.5 million in houses that we need. And that imbalance is going to take a while to get right, because you can't snap your fingers and replace all the carpenters and plumbers and electricians and roofers that all retired in the last 10 or 20 years when the housing market wasn't that great, or moved into other industries, or, let's face facts, moved back to Mexico. All right? We don't have the capacity to make 2 million homes, even though right now we probably have that demand. So that's going to support home prices, because this time everybody that bought a home, they didn't buy it with a subprime or interest only. They bought it with a 30-year fix that was underwritten to very conservative underwriting standards. So we don't see the prospect for a big drop in home prices. Last place in the economy, but 70% of our economy is services. restaurants and, car services, repairing your car and getting a massage and all the services that really constitute 70% of what we actually spend our money on, those prices probably aren't coming down. And the reason is because the number one cost is labor. And we have a labor shortage. We had, because as we talked about way back in March of 2020, the other thing that is probably going to happen when you print trillions of dollars is home prices and stock prices are going to go up. And that made a lot of people who were on the cusp of getting ready to retire suddenly wealthy enough to say, well, let me go ahead and retire. 3 million excess retirements in the last 18 months. That's a big chunk of our workforce, and it is not going to just, snap our fingers and be replaced. That means services or prices are going to probably continue to be elevated. However, service price increases will slow down, in our opinion, as the Federal Reserve slows its printing press, and then sometime early to mid next year, they shut the printing press down for the first time since September of 2019. So, just to summarize, why are we here? Because both President Trump and President Biden embraced an economic strategy for COVID that involved printing trillions and trillions of dollars, despite the almost certainty that that pandemic was going to lead to shortages, and that meant that there would be too much money chasing too few goods. This is a bipartisan problem that has been created for the U.S. economy. What's going to happen in the future? Well, we think prices for a lot of stuff is going to come down. The most important commodity that we feel fairly confident is going to come down is probably oil prices, as U.S. producers get over their anxiousness about all the money they lost last year and ramp up those fracking wells and U.S. production of energy. Prices for homes, prices for services likely to stay high, but they're not, if you want your home to keep going up at the current pace, not going to happen. And I also don't think that prices at restaurants and the grocery store are going to keep going up as fast either, because the Fed's going to be pulling back on the money that they're printing and injecting into the economy. And that printing press shutdown is going to have big ramifications that are probably going to have a quicker than expected impact on inflationary pressures, because the problems that caused them to start that printing press back in 2019, before we'd heard of COVID, we started printing money not to offset a pandemic, but because we were borrowing more money than we could easily finance. When the Fed shuts down its printing press, we'll be back in that situation of the federal government still borrowing $1 trillion, $1.5 trillion, the economy still growing, so people in the private sector wanting to borrow some money too to keep buying houses and cars. And the conflict that led to the Fed starting to print money in September of 2019 will probably resurface. And that will have big implications for investors. And we'll talk about those next week. Thanks for joining us for Market Insights. We hope you found it informative. If we did, we hope you can like the video and share it with your friends. If you'd like to see more of our research, you can find it at caravelconcepts.com. Thanks.